And here we go, folks. Thank you for joining us for today's program. I hope you're all doing well and staying safe. My name is Gary Sarkissian, and I am the Director of Education and Content at CFA Society Boston. Well, 2021 has turned into quite an interesting year for markets. The year started with high expectations for a sharp economic rebound, driven by a full reopening of the economy and the rollout of the COVID-19 vaccines. And those expectations have largely come to fruition. Air travel traffic improved materially over last year. Bricks and mortar retail experienced higher foot traffic, and central business districts saw a boost in activity with workers physically returning back to work. The recovery, however, is not without its complications. The global supply chain continues to be a tangled mess. Qualified labor is hard to find. The housing market has been tight with limited inventory, and as made evident right after the Thanksgiving holiday, the pandemic continues to drag on with the latest Omicron variant of the coronavirus. Mixed into this cauldron of negativity, inflation is creeping its way through the economy, with core consumer prices rising 4.6% year over year in the month of October, the highest increase in 30 years. Macro complications aside, U.S. equity markets are still posting respectable returns this year, with the S&P 500 up about 20% year to date. Leading the pack, so far, have been cyclical sectors such as energy, financials, and real estate. As we look ahead to 2022, will we continue with the same script that we started with in 2021 and assume that all the issues that we are facing are indeed temporary, or are clouds of macro and policy risks forming at the horizon? Our speaker for today's program has spent his entire career deciphering and translating the macro picture. In fact, his knack for crunching numbers and trying to see the big picture has earned him a place in Institutional Investors All-America Research Team Hall of Fame after having won the #1 spot in portfolio strategy in 10 out of 11 years. It is our pleasure to introduce our distinguished speaker for today, Francois Trahan, founder and chief strategist at Trahan Macro Research, an independent research firm that produces macro-themed analysis and quantitative research. Prior to starting his firm, Mr. Trahan was managing director at UBS, where he led U.S. portfolio strategy, and before that, he was founder and managing partner of Cornerstone Macro. He has also served as vice chairman of Wolf Trahan and Company and served as chief investment strategist at ISI Group. Prior to ISI, he was also chief investment strategist at Bear Stearns. He began his career at Bank Credit Analyst Research Group and Ned Davis Research. Mr. Trahan received his undergraduate and graduate degrees from the University of Montreal and is co-author of the book, The Era of Uncertainty, Global Investment Strategies for Inflation, Deflation, and the Middle Ground. Now, before we begin this presentation, I would like to remind our audience that you are in listen-only mode. After the presentation, we will switch to Q&A. If you would like to submit a question to our speaker at any time during the presentation, please use the Q&A button within your Zoom webinar session. So without further ado, Francois, welcome. We're happy to have you, and please take it away.
Okay, thank you, Gary. Let me just get my camera to work here 1 second. I figured out how to get the how to unmute the button. It says you have to okay the camera, Gary, before I can get it to work. I gather people can. All right.
I'll take care of that. Powers of the host.
All right. There we go. All right. Thank you. So before we get started, I have 40 plus pages of content to take you through. We're going to do a few poll questions to try to gauge where consensus currently lies on the markets, and Gary will take us through the results before the Q&A. I see the first question is already on the screen, and so if you could please input your answer on the S&P's total return in 2022. Okay. The second question is essentially the same thing, this time on the 10-year Treasury bond yield, whether it will be higher, lower, or similar to current levels by the end of 2022. give you a few seconds to answer that. There'll be one more after that. Okay, and lastly, I think this one's appropriate. After the events of this week, how many Fed fund rate hikes do you expect in 2022? And the possibilities are from none to 3 or more. This will be the last question. Excellent. Okay, so I have 40 some pages of content to take you through. It's not going to be the most bullish story you've heard. I would say that the more I think about 2022, the less optimistic I am about what might happen to stocks here. So it's been a weird week because we've been pitching essentially the story this year as the Fed making a big policy mistake, ignoring what was happening to inflation. So I was surprised to see a 180 from Chairman Powell to this degree, or maybe this early, I guess. I thought it would have taken a little bit longer to get there. We expected the Fed to raise rates in 2022. I didn't expect it to unfold like this so quickly. So in these slides, what I'm going to show you is what I think will be the 2 biggest macro events for financial markets and stock selection next year. And I'm also going to show you 3 things to ponder when it comes to the outlook for the stock market next year. I think it's fair to say that I am not exactly optimistic. Looking at the headlines this morning on Bloomberg, I thought it was interesting to see the chief economist at Bloomberg with a report that said, here's why inflation won't kill the US recovery. And also to see the strategist at JP Morgan to say this dip is a buying opportunity. So I would say consensus is still fairly constructive. Okay, so I'm going to take you to slide 2. There's a few transition slides in here that are graphics that we've used in our work. And if you look at the title, it says, how did we get here? And what we mean by here is essentially the backdrop that we're in with the fastest inflation rates in decades. Now, there's a lot of moving parts when it comes to inflation. The Fed has argued that it's mainly due to supply chain issues. I think it's pretty clear that they're contributing to the inflation story. We think it's a lot more than that, however, and it's really labor markets that are the root cause of what we would call the inflation problem. But where it's left us, if you look at page 3, we spent many months in the spring and the summer arguing that inflation was likely to be more than just transitory. And I feel like it became mainstream starting around Labor Day. And so, and I think the reason for that is that people started to see the effects of inflation. And so in a recent poll on CNBC, 88% of respondents said that inflation was a significant concern. It's rare to see numbers that are that skewed, but at the end of the day, if you think about it, inflation's very democratic. It literally impacts everyone. And if you look at the pie chart on the right, 48% of folks were expecting to curtail spending because of inflation. And to me, that's the key part in this. It's that inflation essentially erodes real income and squeezes out spending. And so, none of us are really all that familiar with inflation of this magnitude, because unless you were working in this industry in the 1970s, you haven't seen anything like this. And so I do feel like we're all newbies in a way. So, so how do we get here? All right, well, if you look at page 4, we got here because of policy, fiscal policy and monetary policy. The chart on page 4 is a chart I've used for a long time to try to gauge if the federal government's policies are inflationary or not. And so it's pretty simple. One line on here is the prices paid series from the ISM. And so it's essentially the inflation proxy within the monthly ISM report. What I'm showing you here is annual data. And the bold line is essentially the trade-off between how much money the government is spending, and we're measuring that by looking at the deficit, and the needs of the economy. And we're measuring that by looking at the unemployment rate. And so when you sum the deficit and the unemployment rate, what you get is something that actually correlates fairly well with inflation across time. And so in today's economy, where the unemployment rate is fairly low and the deficit is extremely large, what this argues is that we are pumping more money than the economy demands. And so that is a backdrop that historically leads to inflation. It's literally off the charts. And at its peak, it literally hit, if you see where we have the word here with the question mark up there, that's literally how high it would have been. So this is truly unprecedented. I tend to think about this as, sometimes I think about it as structural inflation, but it's clear that the government is spending more money than the economy demands, again, in light of the unemployment rate. Now, when it comes to monetary policy, if you look at page 5, I would say the Fed did what it's been trained to do or conditioned to do. In recent decades, every crisis that we faced or that the Fed has faced has come in one flavor, which is every financial crisis we've had has seen inflation sink and the unemployment rate rise. And so when you think of what the Fed's crises response is, it is based around this pattern. It's based around this experience. And it worked. It worked for a long time. It worked until, if you look at page 6, until, well, we get a crisis that's a little different. We get one where the unemployment rate is lower and inflation is higher. So we are essentially pumping a lot of stimulus. And when I say a lot, it's a lot, in a backdrop where we have tight labor markets and inflation that has already accelerated to 30-year highs. Again, before the Fed has curtailed stimulative policies. And so when I say stimulative, if you look at page 7, I'll show you 2 charts that we look at to gauge this. On the right is real rate. So this is the real 10-year yield. So essentially deepest negative levels since the 1970s. So it's not inappropriate to make comparisons to the 70s at this point. There's a lot of charts that literally will look very similar to that era. Some of you might be familiar with the Taylor rule on the left. The Taylor rule is just a mathematical equation that's meant to mimic the Fed's policy mandate, essentially the trade-off between core inflation and the unemployment rate. And the Taylor rule argues that the Fed funds rate should be above 6% at this juncture. And so declining unemployment rate pushes the Taylor rule up, higher inflation pushes the Taylor rule up. And so we've never seen a deviation like this. When the Fed raised rates for the first time coming out of ZIRP in December of 15, we were about 2 points higher. And the same in 2004, where actually there was an inflation debate a little bit like today, different degree, but similar debate. And we were again about 2 points higher than where the Fed funds rate was. And so a deviation to this degree has never occurred. And so time will tell how this plays out, but in our minds, this is a pretty big policy mistake. At the end of the day, the Fed missed the biggest move in inflation in decades, and then doubled down by calling it transitory before finally acknowledging that it's not likely to be. Now, if you look at page 8, we've written ad nauseum about inflation this year. And it's not like there's one thing that explains what's going on. There's a lot of moving parts. Some, I would say, are likely to be transitory or short-term in nature. I think it's clear to everyone that supply chain disruptions are having an impact on prices, and at some point, those issues will get resolved. What we're fearful is that there are some changes that are likely to be more resilient. And what's happening in labor markets is one of those. We're seeing initial signs of a wage inflation spiral. And that was the heart of the inflation problem in the 1970s. Again, much like today, there were a lot of variables contributing to inflation in the 1970s. The oil embargo, of course, was a big part of that. But when Volcker raised rates in the late 1970s, had nothing to do with the oil embargo. He was trying to break this wage inflation spiral that had taken root in the economy. And to me, that's the inflation problem that we're facing here. The primary driver of inflation is not supply chain disruptions, it's labor markets. We have extremely stimulative policy in a labor market that is already tight. So if you look at page 9, I'll show you 2 charts on this. I'm going to show you a lot more along the way. This is still just the intro. If you look at the chart on the left, there's a lot of great series in the NFIB or in, there's a few other surveys that you can use regarding labor conditions, and they're helpful at forecasting wage inflation. And so this is a series on that the NFIB calls few or no qualified applicants. And it tends to lead wage inflation by about a year. And so what it argues is that from here, where we are today, it argues that wages, odds are, will accelerate over the coming year. So throughout with the visibility we have throughout most of 2022. Now that's a big deal because historically wages is the biggest driver of core inflation. So underlying inflation, if you will, the version that the Fed cares about, the little clip chart on the right shows you another series from the NFIB that we use, jobs hard to fill. So another proxy of labor market tightness with core PCE. And so the official series that the Fed follows. So this is what I'm talking about when I say that it's labor markets that's the primary driver of the inflation story, the core inflation story, that is. Everything else is playing a role, but this is the series that we're most concerned with. And so when the Fed is stimulating in order to help employment, what they're doing is actually contributing to the very inflation story that they claim they're now going to be fighting. Now, in all the comments from Chairman Powell this week, he still believes that the bulk of the inflation issues come from supply chain disruptions. So I would say that that's where we disagree. We agree that there's an inflation problem. We disagree as to the root cause of it. And so, as I said earlier, I spent much of the spring and the summer months trying to make the case for inflation being more than just transitory. And as it became mainstream, we shifted our focus to try to talk about the consequences of inflation. Again, none of us have really experienced inflation to this degree. There must be something that economists in the 70s feared when it comes to inflation. It's got to be more than just the price of groceries. So I feel like right now, housing is giving us a front row seat to the consequences of inflation. At the end of the day, housing is an early cycle industry. It often reacts earlier than the broader economy. So I'm going to take you to page 11 and show you what I mean by this. And so the chart on the left of page 11, this is the price I think of it as housing inflation, if you will, but it's the price of homes in the US, which has gone near parabolic in recent months. So think of this as inflation housing. And on the right is housing sentiment, or one of the series that you'll find in the Michigan Survey of Consumer Confidence. They have very granular data in their survey. And so they specifically ask respondents to tell them how they feel about housing with regards to prices. This is the broader series, Good Time to Buy a House. Well, Good Time to Buy a House is sitting at its lowest levels in history. And it's sort of incredible if you think about it, because we haven't even seen the Fed raise rates, which is typically what brings an end to a housing cycle in the US. And so when you look at the granular data, what you see is that the number one series driving this lower is prices. And so they have a subset that is Good Time to Buy a House. Prices are low, and obviously nobody agrees with that statement. And so that's what's pressuring this series lower. So this is key because, again, housing is an early cyclical. And don't take my word for it. If you look at page 12, there's a paper that was written by a gentleman by the name of Ed Leamer. This was written at the in 2007. And so as housing was beginning to slow, and what Leamer showed was that, first of all, housing is barely covered in economics. And what he wanted to show is how it plays a key role leading up to a slowdown, that it is a phenomenal indicator of an upcoming recession. And the reason behind that is pretty simple, is that home prices rarely ever go down. And so when housing is faced with problems, because home prices typically don't go down, all of the adjustments happens in volume. And so volumes tend to be very, very volatile, and the inflection points tend to be very visible. What the table shows you here on page 12, this is taken from his paper, but essentially Leamer shows that in the year preceding a recession, that housing tends to contribute significantly to slower growth. Again, 1 year before a recession takes hold. Remember, housing is a minuscule part of US GDP, but it tends to account for almost a quarter of the slowdown on average that you see before a recession takes hold. So it's a phenomenal leading indicator of recessions historically. So why did I show you all of this and this sentiment data? So if you look at page 13, because that sentiment data is legit. On the left, here is that same series we looked at earlier. So what I called housing sentiment, Good Time to Buy a House. And I'm plotting it here with new home sales. New home sales, by the way, are down over 20% year over year. Now, you'll read headlines that it's because there's no supply. But again, that's not what the evidence suggests. The evidence suggests that consumers are being priced out of the housing market, that it's the high prices or the housing inflation that is the main issue here. And housing's great because it has very granular data when it comes to home prices. So the chart on the right shows you 3 different series. So again, this is new home sales. So the same series that we have in aggregate on the left. It's down 20% plus on a year-over-year basis. But here we break it down into 3 brackets. So what we call lower priced homes. So this is everything that's $300,000 or less. And if you look at the right scale there on the right, you're reading that correctly. That's down almost 50% on a year-over-year basis. So these are the lower priced homes, typically bought by lower income households. Middle priced homes are important because in this $300,000 to $500,000 range, you're going to find the average house in the US, which sells for about $380,000. That's also down on a year-over-year basis. And so the only part of housing that's still growing is 500,000 plus, or what we've labeled high-priced homes. Even that has slowed some, but still growing quite rapidly overall. Now, that's only about 20% of the housing industry. This is what the media focuses in on, but at the end of the day, it's really a two-tier market. This is the only part that's really doing well still. Now, we would argue that it's inflation that is playing this role, because the data is more granular than what I'm showing you here. And what you're going to find is that the lower priced the category is, the worse the year-over-year data is. So I don't see that as being by coincidence. All right, I want to show you page 14. This chart was just stunning to me. What we did here is compared what's happening to high-priced homes versus low-priced homes. And when you plot those two series relative to one another, what you're looking at is something that looks like CPI. And so again, I think this is evidence that inflation is playing an enormous role in the housing market right now. And we know this from the surveys, where consumers actually tell us that home prices is their number one issue with housing. And you see it in the data. Right now, the lower priced the home category is, the worst the data ends up being. All right, so new home sales definitely slowing. It's housing starts that we really want to focus on, however, because that's where economic activity typically lies. And when Lemur talks about housing in his paper, that's the number one series that he is focused on. So if you look at page 15, I'm going to show you a series that leads housing starts. I called it housing affordability, but it's basically the same sentiment data from the Michigan survey. And so again, think of this as being housing sentiment. It does a decent job at calling inflection points in trends in housing starts. And so starts have slowed in recent months, and housing sentiment tells us that it's going to continue to slow, that this is the beginning or the early innings, if you will, of this slowdown in housing starts. So remember, this is the series that tends to slow in the year preceding a recession. So if this is going to slow in the next 12 months, it's basically telling us that GDP is likely to be in recession late next year or in 2023. So housing starts a very, very key indicator to focus on, particularly when inflation is high. And let me show you what I mean here. So if you look at page 16, look at the chart on the left. When I was talking about the three things I was going to show you on things to ponder on the stock market, this is one of them. So one of these series is housing starts on a year-over-year basis, same series we just looked at. And the other one is the S&P's return. And they are difficult to differentiate here. They look very similar. And it's not by coincidence. What we have found is that the higher inflation is, the more important housing's role is in the business cycle. So essentially, inflation magnifies the importance of housing. So housing starts a very, very key indicator to track. Again, it's very correlated to the stock market at this time, and housing sentiment argues that it's a one-way bet lower for the foreseeable future. So early cyclical industry housing essentially showing us that inflation does squeeze out demand, if you will, and in this case, engineering a slowdown in new home sales that is about to broaden to housing starts. So where does this leave us for stocks? I'm going to take you to page 18. Well, at the end of the day, the stock market is still a leading indicator of the economy, and it's behaving this way. The chart on page 18 is just the S&P on a year-over-year basis. So the S&P's return, if you will, that we plot with the global PMI. I often do this chart with the ISM index, where it works just as well. And so you can see that the relationship is very tight. So as long as the global PMI was trending up, the S&P's return was accelerating. it's lost a little bit of momentum in recent months. So we've spent a lot of time building series that are anticipatory of the PMIs, since the PMIs are very correlated with the stock market. And these are all series that are either rooted in interest rates or in inflation. And right now, what they're telling us is that what you're seeing on page 18 is the very beginning of a slowdown that will last for quite some time. So if you look at page 19, a chart that I've used, I want to say for maybe 15 years or so. So this is the ISM New Orders Index. This is often the PMI that I like to plot. And what I'm plotting it with here is with the prices paid series from the ISM report. And all I've done here is I've inverted it and I've advanced it 18 months. And you can see it's quite an amazing fit all the way back to the late 1940s. And so essentially what happens to inflation today is giving you a heads up on what will happen to leading indicators, to PMIs, in about 18 months. And so 18 months ago, we were essentially at the low point of the pandemic when it comes to economic data, when it comes to interest rates. And so what we should be seeing now are PMIs that are very high, and that's exactly what we've gotten. But inflation, of course, has accelerated. And the clip chart there on the right of page 19, it's inverted. And so what you're seeing there is the acceleration in inflation. It's telling you that essentially the PMIs are going to be trending lower throughout the next year. So very similar conclusion to what housing sentiment tells us about housing starts in 2022. And it's not just the prices paid series from the ISM. We see this in every single chart that we have that helps us forecast the PMIs. I plotted two on pages 20 and 21. And these are the ones that I tend to publish the most. Short rates on page 20. If you look at the clip there, that's just using the 2-year yield. Again, inverted since higher rates weigh on PMIs and vice versa, and advanced 18 months. So this is significant today because 18 months ago, we were at the low point of the cycle for rates, and they've gone up fairly consistently since. And so this is a chart that argues that it's not just the next year, it's the next 18 months of a downtrend in the PMIs. And if the Fed does raise rates from here, these are market rates, well, that line likely continues to move lower, or basically rates continue to rise and would extend this downturn and probably deepen it. Page 21 is essentially the same thing done with the 10-year, so done with the longer end of the yield curve. It doesn't look that different at the end of the day. And so whether you look at rates, whether you look at inflation, what you see are indicators that argued that the PMIs would go up basically throughout most of this year, and that they're essentially topping out now, and we're embarking on a very different world. Gary was talking earlier about how the best performing sectors this year have been cyclicals. That makes sense. In a world where the PMIs are going up, we're going to have very different leadership in the coming year, at least according to these charts. All right, I'm going to take you to page 22 just to show that this is not unique to the U.S. We've seen inflation and market rates rise in most of the developed world, and so page 22 is the same chart done in other economies. So these are just the clips, of course, but this is using inflation, or that prices paid series, as a anticipatory measure of the PMIs in the Eurozone, in Japan, in the UK. The lead times are the same. It's always about 18 months. And the conclusion right now is the same because inflation has accelerated virtually everywhere. And so we're embarking on a very different world. Page 23 is a proxy of global policy that we use to forecast the global PMI. Again, conclusion is basically the same. So we're about to see a synchronized slowdown in the world's economy, or in this case, we're looking at the PMIs or leading indicators, but that will eventually mean GDP. Okay, so what do we own in that context? So let's go to page 25. So I think I've made it clear that we expect leading indicators to trend lower throughout next year, and that's obviously going to be huge for positioning. But we also believe that it's likely that the Fed raises rates next year, and that looks a little more believable today than it did a week ago. That debate has certainly changed. So that's an odd combination. It's not every day that you see the Fed raise rates as leading indicators are losing steam. But it has happened in the past. In the last 50 years, we were able to find 4 instances where this occurred. So if you look at page 26 on the left there, I plotted the ISM with the Fed funds rate. We shaded the 4 instances where this occurred. 2 of those are, unsurprisingly perhaps, are in the 1970s. One is in the 80s, and one might be familiar to some of you. It is to me. It's what happened in the earlier part of the 2000s when the ISM, I remember, peaked in January of 2004 and decelerated for the next few years as the Fed was raising rates. And so it's not an unprecedented backdrop. Now, what's interesting is that in every single one of these episodes, bond yields rose. So despite a downtrend in the PMIs, because the Fed was raising rates, bond yields actually went up. And the column there on page 26 on the right, it's not perfectly labeled. That says the S&P's performance, but it's not the performance during these episodes, it's subsequent. And so every single one of these episodes was followed by a decline in the stock market. Most were pretty potent. The exception is what happened in the late 80s, but again, this is following the crash of 87. So a Fed raising rates in a slowing economy, not a bullish combination. I think that's going to intuitively make sense to everyone. So how do you position for a world like this? So first off, you look at page 27, when the PMIs turn the corner, it's essentially time to shift out of cyclicals and to start thinking about counter cyclicals. So if you're wondering, what belongs in each category, you can see on page 28, we put the subsectors or the industries in the GICs and plotted them there. I think cyclicals are going to make sense to most people. Counter cyclicals are, they're a mishmash of a lot of things, a lot of industries that we would call growthy, and then the pure defensives, if you will, the healthcare and utilities of the world. You'll notice that we also included the average beta of each bucket. And so roughly speaking, the cyclical segments have the higher betas, and the counter cyclicals, of course, have the lower betas. So if you're going to look at one factor, if you look at page 29, if you're going to look at one factor to focus on around this theme, it's pretty simple. It's low beta. You want cyclicality, higher beta when the PMIs are moving up. So when there's appetite for cyclicality, and vice versa on the way down. And so now is the time to be focusing on low beta. It's not terribly exciting stuff, but this is how you outperform in this world. Now, again, counter cyclicals is a lot of things. It's growth and defensives, and they do each have their turn, if you will. So if you look at page 30, this is an illustration of the cycle, and we split it into 3 different phases. And so risk on is a world where the PMIs are moving higher. When they top out, what immediately follows a peak in the ISM and the PMIs is what we call risk off. And so risk off historically is the sweet spot of the business cycle for growth strategies. This is when growth tends to dominate everything else in the market. And on average, you can see there on the slide, on average, the market is usually flat between, on average, of course, between a peak in the ISM and the ISM roughly hitting 50. And then below that is what we call risk aversion. And so that's when defensives really take leadership of the market. And of course, this is where the S&P usually is down. And so, so you want to own growth first, defensives later. That's typically the pattern that you see. So how long will it take for this rotation to occur? If you look at page 31, show you what history tells us. On average, from a peak in the ISM to 50 is 13 months. Now, if you look at the official data in our cycle, the peak in the ISM was in March. And so we're already 8 months into this officially. So this would tell us that we're 5 months away from defensives taking over leadership of the market. But the reality is that it doesn't always happen exactly at 50. In some cycles, it's lower. In some cycles, it's higher. What we have found, and so I want to show you page 32, because this is really interesting, is that the more tightening there is in the pipeline, and I'm not talking about just Fed tightening, I'm talking about a tightening of conditions. And so we would think of that as, of course, being interest rates, but also being inflation. So things that impact US consumers. The more tightening in the pipeline you have, the higher the level of the ISM where this transition takes place. So in some cycles, it's at 50 in the ISM. You can see on the little chart there on the right of page 32, it's happened with the ISM at 55. It's happened with the ISM in the upper 50s. And given the amount of tightening we have today, again, the biggest acceleration in CPI in 3 decades, well, we have a tremendous amount of tightening. So I don't think that we'll have to wait a whole lot for defensives to take control of this market. I think it's going to happen sooner rather than later. And again, this is also where the S&P tends to run into difficulties. So that's the first part of the story on the ISM. So we like counter cyclicals, and I would say we have a bias toward defensives within that. I like all things that are low beta at the end of the day, but within that, I think it's really defensives that are going to be the place to be for most of 2022. Okay, second part of the story. If the Fed does raise rates, which we believe is likely to happen in 2022. So if you look at page 33, the second big macro force, it's that table on the right that you want to focus on. In all the Fed tightening cycles of the last 50 years, you've seen bond yields rise. And so that's the influence for stock selection that you want to focus on. Bond yields today happen to have a disproportional role on leadership or on stock selection. And so what I mean by that, if you look at page 34, because we have some stocks in the S&P that are extremely, that carry extremely high valuations by historical standards, the S&P is having really a huge influence on valuation at this time. What I'm showing you on page 34 is the relative performance of long duration stocks. So all we're doing here is sorting the stocks in the S&P by duration. So you can do this by PE. It won't look that different at the end of the day. And we're comparing the top quintile to the bottom quintile. So the 100 most expensive stocks to the 100 cheapest stocks. Again, we're using equity duration. It won't look that different if you use another valuation metric, and it's plotted with the 10-year. So we have a market where the long duration names are very vulnerable to a rise in bond yields. And so long duration, most stocks that are expensive right now, that group is dominated by growth names. And so normally this is the sweet spot of the cycle for growth stocks. But again, we have a segment of the market that is really allergic to higher bond yields at this time. So we like low beta stocks, but again, we like low beta stocks that also have, what we call short equity duration, or that have lower valuations. Really, that's I think the more appropriate term for it. So I'm not going to get into specific stock selection. We're doing a conference call for our clients next week where we'll dive into that, but I'll show you just a quick summary of how to think about this on page 35. And so this will give you a sense of where we think the opportunities are. And so if you were to pick stocks only based on one criteria, which is low beta, and so you believe the ISM is going to trend lower story in 2022, and you were to look, you decide that you're only going to look at the lowest quintile of beta in the S&P, well, you're going to find that in those 100 stocks, 23 of those come from the healthcare sector. So healthcare is overrepresented because healthcare only accounts for 13% of the stocks in the S&P. So that's a strategy that would be overweight healthcare. Now, conversely, you would only find that 5 stocks or 5% of the stocks come from the technology sector, when tech actually accounts for 15% of all the stocks in the S&P. And so technology would be massively underweight here. And the same goes for industrials, discretionary, and energy. Now, if on top of that, you believe that the Fed also raises rates next year and bond yields are likely to move higher, well, you're going to find that, and so you're only focusing on the 100 names that have the lowest equity duration, the lowest valuation measure. You would find 14 of those names come from the healthcare sector. And so again, healthcare accounts for 13% of the stocks in the S&P. So healthcare would be slightly overweight in that scenario. Technology there at the bottom would provide you with 6% of your stocks. So again, would be massively underweight. So healthcare under both scenarios is a sector that works, healthcare and telecoms, whereas energy, discretionary, industrials, and technology would be underweights under both scenarios. So I think there's going to be few opportunities in the growthier sectors, discretionary and technology, and the very cyclical sectors, energy and industrials. And most of your opportunities are going to be in healthcare / telecoms. You'll see everything else there is mixed. So utilities is an interesting example because when it comes to low beta, there's a number of opportunities. 21% of the stocks were utility stocks in the low beta portfolio. But of course, utilities are for the most part high duration stocks. They're very sensitive to bond yields. And so this is a sector that works under one scenario, not the other. So utility is not that appealing to us at the end of the day. So you can see, we wrote ideal and caution. Those are the sectors where I think the story is the cleanest. Okay, so let me take it to page 37. I'll show you just a few slides as a conclusion. So on page 37, I'm sure you've seen plenty of charts of CPI lately. But again, I wanted to show you that it's not inappropriate to make comparisons to the 1970s. We haven't seen inflation to this degree since the 1970s. And so it's not, the only version of inflation that most people working today have seen is a world where inflation's trending lower and where it's never really been much of a problem. So I don't think we can use the same, recipe or thinking that we have used over time. At the end of the day, few of us have experience with this world. And so myself and all of my team, we have spent this year trying to educate ourselves on the 1970s. We're really just trying to understand, what's different in a world with elevated inflation. There's a number of great books. On 38, I highlighted just a paper by William Poole. For those of you not familiar, he was the head of the St. Louis Fed in the 2000s. And so he's written some interesting things, but the number one thing that I wanted to highlight is that, he points out that at the end of the day, the problems of the 70s were due to bad policy in the late 1960s. And what he's referring to, in the late 1960s, when the Fed looks in the rearview mirror, they've had low and stable inflation for a while. And so they decided that they were going to emphasize employment at the expense of inflation. They decided it was okay to have a little bit of inflation if it created jobs. And so that might sound familiar because that's basically what the Fed did in August of last year. That was Powell's thinking when they decided to try to push the envelope on employment, and we can all see where it's led us. And so the similarities with the 1970s, I'm not telling you that inflation is going to go to the same levels, but a lot of the things that took place are just really mind-blowing. In this temptation to try to pinpoint inflation on one thing, like the Fed has done this year by saying this is due to supply chain constraints. Well, in the 70s, initially, they were blaming everything on the Vietnam War. That was the source of inflation. Then it became the oil embargo. And again, that had, both of those contributed to the inflation story, but that's not what Volcker was after when he raised rates. It was this wage inflation spiral that had taken hold that Volcker was trying to break. Okay, let me take it to page 40. The interest of time, I'm gonna cruise through this. So again, in a world where inflation takes hold, the role of housing gets magnified. So this is housing starts as a leading indicator of GDP from the mid-1960s to the mid-1980s. So in a world of elevated inflation. So housing starts become very, very important. They correlate very well with the S&P's return and do a phenomenal job at forecasting GDP. So keep a close eye on housing starts. I'm going to take you to page 43, trying to be mindful of the clock here, but I'm going to give you a stat that's a little bit mind-blowing. So on page 43, on the left, what you're looking at is wage inflation in the US. Strongest growth rates we have seen in decades. And so on the surface, this sounds like good news, great news. Now, the only problem is that while wages are up a lot, inflation's up even more. So real wages are actually at their lowest levels in 40 years. How crazy is that? That's the chart there on the right. And so in the last year, American workers have lost more purchasing power than in any given year in the last 40 years. Biggest setback in 40 years. And so that's essentially how a wage inflation spiral takes hold. Workers now want to be compensated for this loss of purchasing power. And so they're going to want even higher wages, and companies respond to that by raising prices. And that's where the word spiral comes from. That's how you get caught in this loop that's very difficult to break out of. And so at the end of the day, and I'm going to end with page 44. At the end of the day, it's the imbalance that we have in labor markets, and it's a complicated story. What's happened to the labor force? It's not. You can't explain this with any one series. There's a lot of moving parts to this, but at the end of the day, this is what we need to address. There's a lot more job openings than there are available workers, and so of course, this is a world that's going to lead to wage inflation. And you might recall that very first chart I showed you, wage inflation is what's driving core prices right now. And so that's the potential inflation problem that we have. The supply chain issues are one part of the inflation story, to me, they're not the problem. They will eventually go away. If we're right about the economy slowing in 2022, I would expect the supply chain issues to ease. Commodity prices probably come off the boil. And so headline inflation will certainly look better, much like when the oil embargo came to an end in the 70s, headline inflation looked better. But the US still had an inflation problem, much like we do today. So that's a good rundown of my thoughts. And Gary, if you want to, I know you wanted to go over the poll results before we do Q&A. And so I will pass it over to you.
Sounds good. Well, first off, Francois, thank you for that excellent presentation. We really appreciate the time that you've taken to prepare for this, especially given the events of this past week. So I'm looking forward to our discussion in the next segment of the program. We'll pull up the poll results real quickly, but just want to give the audience a reminder that now we're going to switch to Q&A. So this is an opportunity for you to pose a question to Francois regarding today's presentation. So just remember, if you'd like to submit a question at any time, use the Q&A button at the bottom of your Zoom webinar session or wherever you see it in your Zoom webinar window. So we'll go ahead and share those poll results. And I'm just going to pull it up while we were doing your presentation. I actually punched in the numbers for the poll results with each of these questions. So let's go ahead and take a look here. And first question regarding the S&P. We got a very bullish crowd here, or somewhat bullish crowd. Almost roughly 3/4 actually think that we're going to get a positive total return in the S&P 500 next year. Roughly 1/4 think it's going to be greater than 10%. Not many bearish folks in the crowd here. That being said, moving to the next question. Regarding the 10-year yield, without a question, 84% of you expect the 10-year U.S. Treasury yield to be higher next year. And I think given all the discussion in inflation, that's not a surprising take there. So, and so we'll move on to the last question, and I'll have to issue a mea culpa here. Obviously, there is a scenario where there are no Fed rate hikes, but in my haste and when I put this question in Zoom, I forgot to include that option. So for those of you who don't believe there's a Fed rate hike, we're not ignoring you. But for those of you who do think that there will be a Fed rate hike, it is interesting to see that roughly 2/3 of you expect to see 2 or more hikes next year. 54% of you see 2 hikes at least. So I don't know if you had any comments from that, Francois, before we switch over to Q&A.
Well, to me, what's interesting in that, Gary, is that the crowd is very bullish on stocks, but at the same time expect bond yields to rise. And I don't have the chart in the slide deck, but this year, the correlation between PEs and rates is stronger than I've seen it in my career, so the inverse correlation. And I believe that's a function of 2 things. It's a function of the S&P being growthier than it's been in the past. Again, growth stocks tend to be long duration stocks, so more sensitive to rates. And then number 2, not only is the index growthier, but it's also pricier. The valuations are very, very high, and that just enhances, the volatility, if you will, to interest rates.
Yeah.
So to me, that's what's a little inconsistent in the results, because we have a market that's really allergic to higher rates.
Yeah, given the composition of the broad market index, given how growthy it is, I agree with you on that. I wanted to actually lead off with a question here, and I do see everyone's question in the queue. We're going to kind of have to work at the pace of a high-speed or high-frequency trader here to get through these questions, so we'll do the best we can. But sure. I want to lead off with a question about asset allocation. You're a portfolio strategist, and this, you made the observation that the majority of the folks in this industry never experienced the runaway inflation of the 1970s. And on the same token, I think we can also say that, almost everyone in the industry today is pretty much by and large seeing a secular bull market in bonds. So in other words, we've been in an environment where there's just been a gradual decline in yields, and that is a factor in valuation, that is a factor in backtest, that is also a factor in asset allocation. So my question for
Yep.
you is this a new regime that we're entering in for asset allocation, especially in this, how the last crisis has, when I say the last crisis, the great financial crisis has conditioned us to think that it's important to have a fixed income allocation to offset that equity volatility. Are we entering a new regime? And if so, how would asset allocators have to adapt to that?
So the answer to your question, I think, is yes. So we are entering a new regime from, near zero short rates, and a 40-year decline in bond yields. I don't think that that's a huge call. And also, from the loftiest valuations we've seen, short of the height of the tech bubble, and depending by which criteria, on some valuation measures we're literally at the same exact spot. And so the answer is yes. I think it's a different regime. And, what you want in a world like this is something that can be a store of value. And I think the problem is that people of, my generation, we haven't, we haven't really had to think about hard assets, inflation hedges ever, except in very brief increments, here and there when inflation cyclically, went up for, a few months here and there, a couple quarters at most. So I think people have to figure out how to incorporate hard assets into their frameworks. I feel like, on a personal level, housing can play that role for a lot of folks owning a home with leverage, and and I think some people view crypto that way. I don't know that there is a store of value behind that, and so I don't know that I would see it that way, but I know that some folks do.
Gotcha.
So hard assets to me is really what you have to incorporate into, into your framework.
Gotcha. Hard assets, real assets. Gotcha. Want to talk about housing here. So we got a question here regarding housing and inflation. And it goes as follows. And we talked about this in the past because, housing is a major component of inflation. And so you're sounding obviously very bearish on housing. So the question is as follows. Yep. How do you think about the impact of house prices on inflation indices, in particular, the owner's equivalent rent component of those indices?
Oh, sure.
Don't residential house prices typically lead OER? What is your take on that?
Sure. And so, yes, rent and its proxies account for, I think it's close to 30% of headline inflation, and it's in the upper 30s for core inflation indices. So in weight, they're very large. They don't, rent doesn't move very quickly. And so it doesn't, it's rare that it will dominate the index. So in the case of headline, you never see the impact of rent because headline is dominated by energy prices. Energy is very small in weight, but it's so volatile that it, if you just plot year over year oil and CPI, they look the same basically. So with headline inflation, it really is the tail wagging the dog. It's the small component by weight that tends to dominate the whole thing. On core, so rent has an even larger share of the weight. Historically, rents follow home prices by about a year. And so, I believe there's a major slowdown coming in housing that's already begun in home sales. Eventually, we'll see the momentum in home prices start to falter. But again, that gives you a 1-year heads up on rents. And so we haven't seen that yet. Home price is still, very strong overall. They tend to lag, and so that's not surprising. So for most of 2022, what you're going to see is that rents are going to push up the inflation indices. Now, you won't see that effect on headline inflation. If oil prices come down at all, headline CPI will move lower, irrespective of what rents are doing on headline. And on core prices, I think it will be pushing in the right direction, because most things, I think, will still be, will still be pushing core prices higher. And again, that's the series that the Fed tends to be very focused on. So, they're going to be seeing more reasons, more compelling reasons to raise rates when they look at core PCE in particular. So, and if you want to take this a step further, Gary, so let's assume that I'm right about everything on housing, and that, what we've seen in home sales eventually happens to starts. So home prices will lose momentum, and that would take pressure off of rents in 2023, basically. So down the road.
Gotcha. Maybe a little trip back into the 1970s here. You spent quite a bit talking about that. And we have a question here regarding productivity. So arguments have been made that there was a significant bifurcation in the 1970s where compensation's correlation with productivity became uncorrelated. Yep. Do we expect productivity to decline to meet these wage increases and resolve that divergence? I'm not sure if maybe it should be phrased differently. Do we expect productivity to respond or increase?
Right.
What is your take on that?
So I think I know the chart that you're referring to. You're basically showing productivity and wages, and in the 70s, up until then they'd been linked, and in the 70s they start to diverge. So I've spent a lot of time over the years staring at that. So, I would argue there's a convergence taking place right now because of what we've seen in wages. It's a big gap, and so we're not going to close that anytime soon. But one important feature to think about when it comes to productivity is that its relationship to the economy has changed. And that change occurred about 20 years ago. And so, up until, productivity essentially became very visible in the 1950s when, there was a big discussion on the structural, or long-term growth rate in the economy. And there were different versions of this that were put forth, but that longer term, your growth rate in the economy is essentially population growth plus productivity. And so, that's essentially a debate taking place in the 50s. And at that time, I remember seeing this. There's a scatter of productivity growth and GDP growth, and it looks exactly like this, right? And so the stronger productivity is, the better your economy does. So that relationship changed. If you plot the exact same thing from 2000 onward, it goes from this to this. So productivity tends to be tied to investments. And what you start to see 20 years ago is that investments tend to be about automation and tend to essentially lead to less jobs in an economy that is still a consumer-driven economy. So in the last 20 years, the better productivity has been, the worst GDP has done. They've had an inverse relationship. So that's a really important, variable to think about when it comes to productivity and wages, because in many ways they're now completely inversely correlated. So cyclically, I think it's going to look like those two series are converging, because remember, we expect the economy to slow ahead. That usually means lower investments. That's going to mean cyclically lower productivity. And wages, I think you saw even on the charts we use, tend to lag significantly. So, even if, if we resolve the labor market issues today, wage inflation would still go up for some time just because of the way things lag. Mm-hmm. So I feel comfortable saying that through the end of next year, it's going to look like those two lines are they're definitely going to converge toward each other, but that gap is enormous. I'm talking about the productivity line and the compensation line, which were together. And then in the 1970s, they start to diverge and we're like down here, and now they're going to do something like this for a while. But I don't know that it's a long-term thing because in light of the relationship between productivity and jobs / GDP nowadays, they almost can't converge. Mm-hmm. You see what I mean? Since more productivity tends to be associated with less jobs, basically.
Maybe we can kind of stick with the job market here, because there's been a major factor that there are a few questions that came up that brought up a really important factor here, which is the labor force participation rate. And so so forgive me, there's been multiple questions, so I'm going to pick out the question that kind of sums up this succinctly here. So job market participation remains low. How much of this is a factor in the more jobs versus employees problems? And as a follow-up, is COVID right now still creating a drag? And if COVID subsides and people feel more compelled to work, especially in the riskier industries, does the employment situation flip? So how would you address that question regarding the labor force participation rate and the gap between jobs and openings?
So it's it's a big part of it, right? When I talk about that very last slide we looked at, where I showed essentially job openings and available workers, that can be addressed by, partially anyways, by the participation rate. The issue is, how do you make it go up? And that's the tricky part. And when I think of all the things that have impacted the labor force, it's not simple. I think COVID has undeniably played a role, but I don't know that if COVID goes away, that means that all these people rush back in, because some of those folks are folks that have been impacted by COVID. We have data on how many people died from COVID. We don't have great data on how many people are incapacitated, and some permanently. And I think everybody on here probably knows someone in, that's faced with that scenario. So that's one part of the story that we just have no visibility